Hey there, welcome to the channel. So just going to look at some stocks today. So basically, kind of interesting week, right? We had so this is on Thursday night. And so we had some, good updates throughout the week, right? We had this was last week, and then we had, Monday, Tuesday, Wednesday, and then today we had this big sell-off. Looking at this, this kind of looks like the dead cat kind of bounce to me, because if you look at it, you're finding support here around the 200-day moving average. We pump back up, but now look at, you're hitting at the 50. This is the daily. The purple line, dotted line, is the 200 days. So we get this rapid few days of basically we ramp out over the 200-day. But what's interesting is if you look right here, we get resistance right at the 50-day, and now we've come back off. So we had a mixed thing. We had, like, earlier in the week, we had some really good earnings and stuff like that, and that helped pump the market up. And then we had some kind of bad earnings and stuff today. So that's what we're seeing. Looking at, what's interesting. So now here, if you look at like SPY and we go back out, we look at the weekly, you can kind of see that you're still kind of in this, still in this uptrend. And the question is, are we, entering and transitioning into a bear market? Well, you can see this is a kind of an interesting place here, because it depends where this bar is going to close up. But going into tomorrow, now we have kind of it's not a great bar because we're closing poorly. In other words, we're not closing at the top of the range. We're closing below the mid range. Now, tomorrow is going to be the jobs. ADP report wasn't very good. So it's very possible that tomorrow the jobs report could be a rather negative catalyst for the market. So we'll see what happens with that. But if we look, for example, at the Russell here, you can see, look, we've already had a lot of damage here. And now, even if you really need serious rallies to really kind of undo the damage. And this is why, my view is kind of like, look, we're entering a bear market. We're not really there yet. I know that, the commentators love to say, oh, correction is 10%, bear market is down 20%. But I look at it relative to the charts, in terms of the cycle. Here we're still in this uptrend. We're still above the moving averages, but we're pressing against them. We're starting to get some selling pressure, and that's creating that problem. Now, I do certainly agree that if you look at like RK, this innovation fund, this has been beat to hell. And it's kind of actually interesting. Like, it depends how it closed. But looking at this week right now, I mean, that's a terrible bar. And the reason is because look, you had a decent rally in terms of, you were, at 70 and you made it up to past 75, 77, but now you're closing down the bottom of the range. So that's just really bearish. And so now, if you look at that, what's kind of really happening here is we were definitely oversold, right? So coming into this week, and we're just really oversold. So looking in, we had last week, we had this closing bar here, this guy right here. So we had that strong thing, and then we, opened up with a good strong day, another good strong day, and another okay day. And then today we got the crap kicked out of us. But this is sort of it just may be relieving that oversold kind of pressure. That's what it's sort of looking at, because now, once again, we've had this kind of bad day, and we'll see what happens tomorrow. I wouldn't be surprised they try to gap this thing up, et cetera, but it's not very much it's going to be really tough. And then, so now going back to the big picture, if you look at it, your SPY is holding up maybe the best out of the major averages, and your NASDAQ is taking more of a beating here. It's interesting, look at that. When you see that failing to get above the moving average, that's certainly a negative catalyst. And then looking at the IWM here, this thing is in really bad shape. So I would not be surprised, and this is not financial advice, this is just me speculating, is like, I wouldn't be surprised that the job numbers come in kind of horrible tomorrow. And that, as a result of that, we kind of get a decent sell off. And then we'll see what kind of happens with the Fed. Now, here's one of the interesting ones on shift. This guy kind of got beat up. We had a little rally. So if we go to the daily chart, I mean, you had like right here, this day here was, I think, a 12% up day. Yeah, this one right here, this was a decent move up on that day. But look, it just gave it up. There's no momentum. There's no follow through on this stuff. So this is all just bear market behavior. On another note, if we go and look at the national debt, historic event here. I mean, in many ways, it's not historic because, this record will just continue to be beat. But, we crossed the $30 trillion mark. And that's just rather an amazing thing. If you look at that 30 trillion, I mean, there's just no way to pay that off. I mean, if you go and you look at the richest Americans, the richest 400, whatever, they might have 4 trillion, 3 or 4 trillion of total net worth. And that's the richest Americans. And that might be the richest people in the world. I don't know. I think Forbes has something on that. And I'll do a video on that. I'll go research that. But last I checked, it was $3 or $4 trillion. And $3 or $4 trillion, and that's the markup prices. In other words, that's the value of their companies, the value of the public shares that they own, the businesses that they own. They couldn't really sell it for that. So when you're at that kind of a point where you just cannot pay off this debt, it's going to be interesting. I mean, how long? I have this saying that I say, like, can we stop acting like children? And this is, another case that, like, can we stop acting like children here? We have to like acknowledge that this is here. We have to acknowledge that it's so big now that you can't just tax your way out of it. You can't just tax the rich. You can't just tax the rich corporations and magically solve this. If you go to your biggest companies, yeah, they got billions of dollars, they got hundreds of billions. Some have like $100 billion in cash, like the Apples of the world and stuff like that. But, you have to remember that you're talking 30 trillion, you're talking 10 times of scale, we call that an order of magnitude. And so if you stole all that money from all the biggest US corporations, even the other corporations, let's start a war and just steal it from everyone. But you're still not even going to make a dent in this national debt. So what you have is, we definitely have crossed the Rubicon here. We definitely crossed the point where, we can't go back. And it's really interesting too, because this debt per citizen of $90,000. I mean, think about that. Like, I'm in California, like all the homeless people, like each one of them owes $90,000. Like, they don't have the money. I don't have the money either. And I'm very fortunate. I'm doing a heck of a lot better than those people. But oh my God, I don't have that. Like, what are you going to do? And I know everyone says, well, let the rich pay, the rich pay. Like you can do the math. There isn't enough rich people that are rich enough to pay for the rest of us, because hence the 30 trillion. So it just doesn't work. And then the odd one as well is, look at this, 239. I mean, 239,000 per taxpayer. Well, okay, so a bunch of people aren't paying any taxes at all. So, for considering only the people that actually pay taxes, now it's that much more. I don't have $239,000 to pay my share of the debt, and I'm sure most other taxpayers don't either. And admittedly, this is a little suspect here, because what's happening is this is like income tax. Everyone, even the poorest guy at the Circle K, is still paying those payroll taxes. So they are paying a lot of taxes, but they're not paying federal income tax. So this is, what's interesting, because we just crossed this $30 trillion mark, and there's no way out. It's just going to keep happening. And I think that we could take, I had this video on the Ukraine thing, I think it was a week or so ago. And, I try to bring a little bit a different perspective to that. Let's try to look at how the outside world looks at it. Right now, you have to understand that the US is the world's reserve currency, and it means a very specific thing. We're the reserve currency, and that means that essentially on a worldwide basis, people are using the dollar. So therefore, the inflation in the dollar, et cetera, the value of the dollar, how many of those we print or don't print or create has an effect not just on us, on the entire world. If, for example, if you're talking about the Canadian dollar, this is a big modern country, Canada. If they go out and they decide, hey, we're going to go increase the money supply by 25% a year for the next decade, their currency will get devalued relative to other currencies because they're making so much extra of it. And in addition, their citizens would suffer a little bit from inflation, right? But see, it wouldn't necessarily affect the rest of the world because the Canadian dollar is not the world reserve currency. Now look at what the U.S. does. We go and we created we just increased the M2 money supply. Like the year before, we increased it by 25% in one bloody year. And if you look at the chart, it's still just going up. But the point is, everyone's using that. So that means as we put more of those dollars out, it's like anything else. It's actually really, really simple. Economists and pundits like to make it very, very complicated and try to make it confusing. But it's not, and it doesn't need to be. It's very simple demand. Take any situation that you're in, any situation. And if you have a lot of money in that situation, the more money just causes people to chase the goods. And what that means is the price of goods go up. And therefore, the value of that money goes down. So when the US is printing all this money, other countries are still stuck using it. They're still stuck settling payments in the dollars. And therefore, the value of the dollar going down is affecting them. It's affecting the whole world. So if you looked at things and you said, well, if I was another country and I held $1 trillion of reserves in treasuries, for example, and I'm like, wow, you just increased the money supply by 25%. What have you done? You decreased the value of my asset that I'm holding by 25%, right? You increase the supply by 25%. There's 25% more of them out there. And then you just devalued the amount that I'm holding. So at some point, and we're not there yet, but at some point, this has got to create international friction. And I think it already has. When you're dealing with like Russia and you're dealing with China and other countries, that ship has already sailed. They've moved on from the dollar because they've realized this a while ago. But, when you're talking about Europe and you're talking about other parts of the world, they may not really be there yet. So I want to take one more look at the dollar. I was hearing that the dollar was down today. Yeah, so this is interesting. We've had this really big move down in the dollar this week wow, that's a really big move. So the dollar really kind of getting hammered. But if we go to the weekly chart, we still have this big base in the dollar. But let's take a quick look at this here because maybe, so what we have is we kind of have this W base here, right? Here's our W, and it's kind of extended up, coming out. And we broke out of this area, But what I will say, just looking at this chart, is that, hey, this is a big, bad weekly chart, So now as I've said in other videos, I'm like, hey, just looking at the chart, my view is that, hey, maybe the Brent Johnson guy is right, and we're in that situation where the milkshake is happening, and the value of the dollar is going up because there's like a run on dollars that people, corporations need the dollars to settle all the dollar debts that they created due to the financial system. Basically, it has to do with what they have is what they call the euro dollar system. But the thing is, now this may be like a game changer. Now we will see. I don't know, but that's a pretty big bar. So I think if you look at that and you say, that's something to kind of pay attention, is that bar, and look at the volume on that. That's really interesting. Now, of course, this is just an ETF volume, so it's not a complete thing, but that's a big move on the dollar. So let me actually just look one more thing here. Let's try to look at yeah, so So here I'm looking at an index. So it's the end of day cash settlement. They're basically marking the price of the dollar at the end of the day. So yeah, so far this is a really bad week and it undercut the week there. So this could be a trend reversal in the dollar. That's very, very interesting. Why would that be? So that's kind of interesting. So let's try to speculate. Why would the dollar reverse? We believe that the Fed is going to go and follow through and increase the interest rates. There's been, part of the issue with the markets. There was some earning problems this week, but one of the problems as well is that, it seems like they're going to follow through. They're reducing their purchases of treasuries and mortgage-backed securities. All that seems to be happening. And so why that would, if the interest rates, if the Fed moves the interest rates up, you would expect the dollar to go up a little because it's more valuable, right? You can take and buy a treasury and you can get a better, yield on that theoretically. But so that's interesting. So I have no answer for that, but that's maybe of note. That if the dollar, now look at that. Now, if the dollar reverses, let's say, so the thing that I just noticed here is that, look, if this dollar trend was going to continue for the next year and it worked its way up into this resistance over here. So like this guy here. So this is the kind of the area where you wonder it'll hit this. There's a lot of resistance up there, but if this thing kind of just kept working its way up for like half the year or something before getting up to here, the dollar could be significantly higher. Well, if that changes now and this actually starts bringing it down, then that's kind of an interesting thing because now we can start speculating. So let's start speculating. Well, if the dollar comes down, one of the things that I would say is what has been happening to gold throughout a lot of this cycle over the last, 2, 3, 5 years. Well, if the dollar's going up, that's going to put pressure on gold. It tends to do that. And also gold really has struggled to just go anywhere. It's not going anywhere. So now I wonder if there's a potential opening here because you have the gold is just, really hasn't been going anywhere for a year and a half. It's just been in this kind of big, and this is some people would call it a wedge or this or that. And it's not, I wouldn't call it any of that. I just say, look, you have a consolidation pattern, but the important thing I'm trying to point out here with it is that it hasn't broken down totally. It's like, yes, this thing came off from 190 or $1,900 an ounce all the way down to 1,600. That's a lot. I'm not saying that's not a lot, going all the way down to here. But my point is that, in the last year, it's actually kind of the lows are getting a little bit higher. And you're wedging. It is kind of a wedge. You see that it's wedging down. So the point is, this is this one big, huge consolidation pattern. So now that would be interesting if, and you can see this here, you had this bad week here. But the thing that's going on is if we get some relief on the strong dollar, if that's the case and we get some relief on the strong dollar, I wonder if, and given all the problems with the Fed raising interest rates and all that. And, basically, if you look at it, you will see that we're at the point where like a lot of people are like, look, we're coming for a recession. The Fed isn't going to be able to make this happen correctly. Forget it. They're never, you can't just raise rates. Our economy is just not in a position to do that. So if that's the case, so if the dollar now is coming up, you could kind of see this argument that I'm trying to make here poorly, but I'm trying to make it anyway, because the dollar was doing its thing. So this dotted line, I put the dollar on the same chart, and you can see that the dollar is doing that W. And so this whole period of time here, the dollar was working its way up. You also had the dollar dropping back here, but during most of this period of time, you kind of had this base in the dollar, right? So this whole period of time, you got this base in the dollar. Well, if that base in the dollar, meaning that the dollar wasn't just falling off a cliff and dropping through the floor, if that is part of the reason that gold has been restrained, if the dollar actually does make a turn here and starts heading down into that lower end of the range, like 138, I mean, it's got some room to move. You're at 154 and it could go all the way down to the bottom of this base at 136. If it starts moving down there, that might be the opportunity for gold to make a breakout here. And then given the volatility and all the other stuff going on in the market, and basically, looking at things, it's like, okay, yeah, recession's coming. That's what's going to happen. We're going to go into recession. It just seems very unlikely that we're going to avoid it. So I know that's all kind of early, but that seems to the direction we're going. So I think that's it for this one. So there are some interesting things going on with the chart. We'll see what happens with the jobs tomorrow, but I suspect it to be a bloodbath. All right, later. Bye.